It Real, the largest podcast made by real estate agents and for real estate agents. My name is DJ Paris. I'm your guide and host through the show. And today is our monthly episode, Learn with a Lender with Austin Clarence. Now, let me tell you more about Austin. Austin Clarence is a top producing mortgage loan officer and investor financing specialist offering loans through Nexa Mortgage, which is the largest mortgage brokerage platform in the United States. By leveraging over close to 300 wholesale lenders nationwide. He structures everything from conventional and FHA loans to advanced investor strategies, including DSCR, short-term rental financing, construction DSCR, and 15% down investment property programs. Very cool. Austin is also known for solving complex financing scenarios that traditional retail banks often decline. He works closely with residential and commercial real estate agents and investors to help them get more offers accepted, close more deals, and grow their real estate portfolios strategically. Through his Learn with a Lender segment here on the show, he delivers practical, up-to-date lending insights that agents can immediately apply in today's market. I want everybody to follow him on social media. You can track him across all the channels, but if you're on Instagram, it's austin.mortgage. In fact, that's his handle on pretty much everywhere. Just look for Austin Clarence, but austin.mortgage on Instagram. And also, I want everybody to email him or shoot him a DM on Instagram to get on his Wednesday weekly newsletter. It's his tidbits that agents can use when they're talking to clients. You can email him at Clarence, that's CLARENCE. So Clarence at Nexa, Nexa lending.com. So again, shoot him on Instagram, austin.mortgage, or on his email, and we'll have links to both of those in the show notes. And one more thing for everybody, while you're on Instagram, put a follow to the Keeping It Real podcast. You can find us at Top Agent Interviews or just search for Keeping It Real podcast. Give us a follow too. We post daily short form videos to help you with your real estate practice. All right, Austin, welcome back to the show.
DJ, thanks so much for having me on again. Appreciate it. Looking forward to the conversation.
Yeah, I am really excited. I know that before we went live here, you were mentioning that there's a condo update that agents need to know about. I don't know about this, so I'm excited to have you tell me. So what's going on with condos?
Pretty huge update. I think you guys will probably see some more newsletters, information, articles about this because it has pretty big implications. It's not really a niche issue. If you sell condos, list condos, or own a condo yourself, this is going to impact you directly. Fannie Mae and Freddie Mac made a massive change just the other week with condo financing. And again, Fannie Mae and Freddie, they set the standard for underwriting for all conventional loan lenders. So when they make an adjustment, everyone has to apply this to their guidelines pretty much immediately. So what happened here? Previously, if you were financing a condo, the lender requires 10% of the annual budget has to go into a reserve fund, which you can think of it as savings to cover roofs, elevators, parking structures, the big ticket items. The new update is it's now jumping up to 15%. So that doesn't sound that massive of a jump to you, but it's a 50% increase in what the HOA now has to budget for their reserves, conventionally financeable. So this is officially going to go into effect January 2027. So we have a little bit of time while this gets rolled out, but there's pretty massive implications that we're going to be chatting about here. Again, this only applies for conventional financing. So FHA, VA, that really falls under HUD itself. Conventional is going to follow directly with Fannie and Freddie. So this new update, what it really means, these HOAs are now going to have to account for a ton more money that's going to go into these reserve funds, which is not the most exciting thing if you own a condo yourself. Having money go into reserves isn't necessarily the most ideal thing. You'd much rather have lower HOA fees. What I was reading is in Phoenix, Arizona, so far this year, HOA dues are up 20% already from last year. And this is before this is even rolled out. So with construction costs rising across the country, we've seen a ton of HOAs nationwide have really bumped up their quarterly or monthly HOA fees. Now with this 50% increase in the budget, I think we're going to see a pretty massive increase in HOA fees across the country. in order for those HOA associations to remain eligible for conventional financing.
Yeah, that's particularly interesting. So I live in a three unit building here. We manage it ourselves because there's just three of us. And I have no idea what percentage of our budget, I'd have to go back and look, go into the reserves every year. I hope it's at least 15%, but it might not be. And because we're such a small organization, it's not something that I think about ever. And I'm also not the president who lives directly above me. So I do need to ask her this because this would affect buyers who are, again, this doesn't start till next year, but it would affect buyers who are looking to get a conventional loan.
Exactly. Anybody who's taken out a conventional loan. So there's really two updates. This is the biggest update that officially goes into effect January of 2027. So if you're talking to a seller of yours that's thinking about listing their house, they're not sure whether they want to do it now, wait for rates to drop, maybe fall, maybe next year. This is a good time to have that conversation that your particular condo complex is not going to be eligible for conventional financing. There's a chance unless they're hitting this budget requirement. And just to kind of elaborate on how this works, the vast majority of HOAs across the country, they just do the bare minimum to remain eligible to
Sure.
appease Fannie Freddie. So they hit the minimum 10%. So now all these HOAs and associations across the country that are right just barely hovering over that 10%, they're gonna have to make some pretty big decisions, hiking their HOA fees in order to reach that 15% by next year. So I think we're gonna start seeing HOA fees ticking up across the country now in a lot of complexes that maybe weren't loaded with cash. But yeah, it officially goes into effect January. So definitely a good idea to start preparing and doing your research and homework now for how this can impact you.
I also see a huge opportunity for our listeners to reach out to everybody they know that currently owns in a building that's has an HOA. And this is a conversation, at least I guess just for condos, this is a conversation that you as the agent can have with the owner who may or may not be on the board, but to say, hey, can you get me in front of the board? I want to just give this information so that they know. It's probably a good opportunity to, again, just because I don't know that I would know this. I can't imagine unless the person that reviews our finances here at our building, I don't know how we would ever know about this.
Exactly. And one other thing I wanted to point out, DJ, officially on August 3rd, anyone who buys a condo with conventional financing has to go through a full condo review. Before, you only had to go through that full review if you had 10% down or less. So that deadline, August 3rd, is coming right around the corner. Anybody with conventional financing after that date is going to have to go through the full review because before the 10% only applied for the full review. Now it's going to be everybody after August 3rd, regardless of the actual down payment. So, good idea to start thinking about how this could impact you. I know 50% increase in a budget is going to be a pretty massive increase in a pretty
Yeah.
short period of time. So I think a lot of HOAs that just didn't have a ton of cash in the bank, have a lot of reserves, they're going to really have to think quick on their feet here how they're going to be able to come up with this number. Again, if a condo complex can't meet this requirement, it's just simply not eligible for conventional financing. Of course, there's other loan types out there, but conventional makes up the vast majority
Sure.
of loans across the country in every single market. So if a condo complex cannot get conventional financing, what do you think is going to happen to demand and home values? There's going to be a pretty big drop,
Right.
and more likely home values in that association probably going to suffer as a result. So could be a little bit more volatility in the condo asset class over the next 1 to 2 years as this gets rolled out and officially implemented. I think eventually the dust will settle, but definitely a good idea to start thinking about how this can impact you directly.
Yeah, and I think again, the action step at the easiest action step I see for our listeners is use this as an opportunity to say, hey, if you're a condo owner, here's something you need to know about and have a conversation with your HOA. You can make a short form video about this and post it on Facebook, Instagram, TikTok, etc. I would go a step further and start calling everyone and say, "Hey, this is really important information your HOA needs to know. You guys are probably okay, but let's do a check because if you want to sell in the next year and all of a sudden they find out this isn't the case, then association will have to scramble to redo their budget and make it official." So this is something that I suspect 99% of associations are not going to know unless they're professionally managed by a company that knows these things, that maybe brings it to their awareness. But so many of them are like mine, where it's just there's three of us, so we don't know, when these kind of things happen. So this is really great information, and you can use this as an agent to reach out to people who already own and have a conversation, even if they're totally okay, just to let them know that you know what's going on. I see that as a huge win. So thank you for that. That's a great opportunity. And also, if if the HOA is having an upcoming meeting, then perhaps, you as an agent, even though you're, not necessarily pitching your wares, you would be able to go in and have a conversation in front of the board, and then that's possibly some leads for you. So great opportunity there to think about how to grow your business using this information. Now, real quickly, because you mentioned condos, does this not affect townhomes, or does it also relate to townhomes?
Correct. It's only going to impact attached condos, which is, I guess, 95% of all condos out there. I'm not sure if I've ever actually seen a detached condo, although there are some
Me
out there.
neither.
So if your condo is attached to another property, even if it doesn't look like it, if it's barely attached, that's considered an attached condo, which falls into a slightly different asset class for lenders. All has to do with the risk because the property and the values are going to closely correlate if they're touching in uniform. So this does not apply for townhouses, obviously not single family houses. Condos are going to be really the only ones suffering from this new rule. Again, a lot of time it can be tricky because you might see a property for sale, you might send it to your buyer. It's going to say townhouse. Okay, perfect. We're in the clear. Turns out many of these, from my experience, the majority of them are actually attached condos. If you pull up the county records, 9 out of 10 times, that should clear up the air. Ultimately, the appraiser has the final call, but county records almost always will specify condominium, townhouse. I can't tell you how many times I've seen a listing where it even said the Woodland Park Townhouse Association or the uh, Illinois. It has the word townhouse in the name, and it's still a condo.
Still a condo. Yeah. Right.
Exactly. So I know it can be a little bit more appealing listing it as a townhouse, which is that's your prerogative if you want to go that route. But this only applies for condos. So a good time to educate our buyers, remind them that if you're looking at condos, townhouses, these are the main differences that could come up with additional hurdles. There's additional documentation for condos that wouldn't apply for townhouses. And now there's this reserve requirement that'll probably be an issue for thousands of complexes across the country
Yeah.
over the next year or so. So obviously not a reason to make your buyers freak out, but just a good idea to give them this nudge, this little tidbit of information, and more importantly, have them reach out to their lender, ask them the differences from the lending standpoint of how a condo will play out as opposed to a townhouse.
Awesome. Thank you. All right. I want to move on to a new topic, which is something that we don't hardly ever talk about on the show. And this is going to be particularly helpful to our listeners about bridge loans and HELOCs. So these are two terms that a lot of agents really aren't that familiar with. And Austin's going to arm you with just a little bit of information that you can use in your conversations to feel more confident and really help explain that you are an expert with respect to not just obviously the properties to choose, but that you have a little bit of information to be dangerous around lending. So let's talk about bridge loans and HELOCs.
Yeah, good point, DJ. You said you as a realtor may not know this program exists. So do you think that homeowners know this program exists? Probably not, right?
Definitely
It's
not.
going to be foreign to a lot of people, but has become really popular over the past couple of years. A bridge loan is essentially if you own a property, you want to purchase another property, but you don't want to have to wait for that property to sell before you move out of the house to buy another property. A bridge loan allows you to tap into that property's equity, access to cash. You can either pay off debt or just simply use that towards your down payment for the new house before that property sells. So it can be huge. Obviously, never ideal to have to sell a property when you got pictures of grandma on the back, you got breadcrumbs on the counter. Not going to be as marketable, not going to be as fun for you, the realtor, or the actual seller themselves. So bridge loans are huge because you can tap into that equity, typically up to 75% of that property's value. So it's not going to be every last dollar. Of course, the lender has to leave a little bit of a margin in case home values do decrease. Typically 75 to 80% of that property's value you can tap into. You can put a big down payment on that new house, or you can even buy it outright with cash before that property sells. So again, DJ, like we just discussed, great program. Most homeowners just simply don't know this program exists. There's a million variations of this program. And it's a great conversation to have from your buyers that already own real estate, want to buy another house, and that don't think they have the cash to be able to do that.
Ah, that's so interesting. So yeah, this would be this was a great. I'm a great example of this. So I sold my last condo, and I had to wait for that to clear before I was able to purchase my new one. Even though we had a contingency on it, which again is fine, and it ended up working okay. But this is an alternative to having a contingency. And so tell me a little bit about when you would use this versus just having a contingent offer.
Exactly. And every market's going to be a little bit different. You might be able to get away with a contingent offer without it being a huge detraction from your offer.
Yeah,
In some
basically,
markets,
I'll jump in. I got lucky because I knew the listing agent of the place I was buying, and I'm like, "This is going to sell. We are good." It was a cash offer on my last place, so that made it real easy. But yes, it could have gone south at any time just because it was a contingent offer, and they had other offers. So thankfully, I got a nice favor. But this would actually make it a much stronger offer.
exactly, because oftentimes having to wait for that other property sale, especially in this market when any property is just taking a little bit longer than it was 3, 4 years ago, as we know to sell, that's going to make a pretty big detraction off of your offer. So, bridge loan, very simple. You can think of it as a short-term financing, typically 6 to 12 months, allows you to access all that cash. And the most important part, you do not have to put a contingent offer in. You can do no contingencies, or at least not have to wait for that other property sale when you write up the contract, which is going to make a huge offer, sorry, huge impact when that offer is going out. So most people nowadays, especially if they've owned their property for a while, they probably have more equity that they can tap into for that property. So more equity, the better. They might even be able to pay cash outright if they have multiple properties. You can take out multiple bridge loans. Ultimately, it's a short-term loan, so these loans are going to be paid off as soon as the other property sells. The lender typically charges a fee of roughly about 2% of the listing price. You do have to sign a contract that it's going to sell within 180 days or 6 months, a year. There's a million variations of this program. So there's a little bit of flexibility. So it's not a one size fit all.
Got it. So you're paying 2% or so roughly, depends on the lender, I guess. But to basically get this short-term loan, 2% of the purchase price. Right. Um, or is it of the appraised value of the previous home? I guess it would be the purchasing home, I'm guessing.
Yeah, good question. It can be both. It can be the list price, like the actual sale price of that property, or it can be of just the loan, the money that's borrowed. So there's a few
Got it.
different variations of it, but that's the great part about it. It's not a one size fit all. So if you're looking for something very specific for your situation, there probably is going to be a program out there. I've accessed about 15 of these that all work a little bit differently than the next, slightly different cost of interest rates versus fees. They all essentially are going to accomplish the same thing to allow you to pay off bills. You're not going to have to worry about debt to income ratio because you're going to get a guaranteed offer from the lender to buy that property that's doing the bridge loan. Therefore, you don't have to qualify with two mortgage payments and your DTI. And that's oftentimes why this program is such a big hit, because qualifying with two big payments, two big mortgage payments, can be a challenge for a lot of people. So the lender essentially ignores your current mortgage payment because you have that guaranteed offer for that property to close in case it doesn't sell on the market once it's listed.
Yeah, I think I see this really as a pretty simple. There's an opportunity here for people who find their dream home before their other home sells, right? So this is, and hopefully they've been at that previous home for a long time. They have a bunch of equity. You pull that out, and you're paying a little bit more than you would be on a conventional loan because, of course, it's short term. So there's a little bit of cost there. But in order to secure the offer, secure the deal, might make sense. It's probably peanuts when it really comes down to it in order to get that deal closed, because we know contingent offers off sometimes don't go through, and there's lots of reasons for that. So this is a great opportunity. So talk to your lender, or better yet, call Austin when you have this situation. If somebody has a lot of equity in their previous home, they are in the process of getting it ready to sell. Maybe it's not completely going, ready to sell in 2 days. I got lucky. My condo sold in 2 days. So I got really lucky. My contingent offer was not that big of a deal, but a lot of places take longer than that. So this is a great opportunity. Call Austin, tell them you have somebody who wants to move, and see what options exist. That's an awesome thing. So thank you for that. And let's talk about HELOC now.
Yeah, for sure. So a HELOC, similar program to a bridge, you can think of it as tapping into that property's equity. This is not going to be as strict and stringent. It's not really based off the sale of that property. So traditionally, a HELOC wouldn't be a great vehicle to take on a property you're selling, but there
Sure.
are options out there that would accomplish that same thing. Or let's say that your client owns a property and they have equity in it. They don't even want to sell it, but they just don't have the liquid cash to come up with that 5, 10, 20% down payment. They can take out a HELOC against that to cover their full down payment requirement. Down payment funds for lenders can never be borrowed. It cannot be a personal loan, can't be money you're going to give back. I'm going to give back to DJ next week, but it can be borrowed if it's against a secured property, such as a
Oh,
mortgage. So HELOCs can be a great way to fund your down payment, to pay off debt, to get closer towards making that next purchase. You can also do a HELOC to tap into an equity of property on a property you're about to sell, and then pay off that loan, and then have that down payment fully covered by that HELOC. Traditionally, HELOCs were done and really dominated in the banking sector of the mortgage industry. Now, over the past 5 to 10 years, we've seen technology really take off that a lot of banks haven't really kept up with. So it's more direct lenders, brokers like myself that have access to these programs. There's some programs out there. I just closed one last week. My borrower owns the property for several years. They applied on a Wednesday. On Monday, they closed and had the money in their bank account 2 days after that. So it's
wow.
almost easier to get approved for a HELOC nowadays than it is for a credit card, and probably faster for that matter, because the technology, they use AVMs instead of ordering traditional appraisal. You don't have to shell out $700, see if it appraises. It's going to pull an AVM in lieu of an appraisal credit check. It's just going to be a soft credit check. So you can literally apply within 60 seconds. You're going to see your exact interest rate, terms, how much you would qualify for, and then either decide to move forward with the application, become cleared to close within 1 to 2 business days, or look at another option. So there's so many of these AI powered HELOC programs out there in the industry that are completely hassle free. You don't have to go through that terrible process with the bank, go in person to upload the documents and see if you're approved, work in underwriting conditions. Most people are closing within 7 business days with these programs. So the simplicity is a great topic point for these homeowners that are looking to buy another property. They just don't have the cash liquidity right now,
Yeah.
have the equity. And that's why it's going to be huge. A lot of these homeowners just don't know these programs exist. If they knew how simple it was, they would take advantage of it. And that's what we're really starting to see over the past couple of years. These programs have really expanded.
Yeah, so you would basically use this when you have somebody who's got a bunch of equity in their house. Maybe it's not liquid, or maybe the home isn't selling as fast as you would, or don't think it's going to sell as fast as it you'd like it to put an offer on a new place. And a bridge or a HELOC may be an option. Again, consult your lender. Better yet, consult Austin. This is what he does. He will bring these to you, but you now can say to your seller, hey, there's a few other options here. If you don't have a down payment, if you don't have a liquid down payment, we might be able to pull it out of the equity. There's a couple of different ways we can do that. Let me get you in touch with Austin. So that's really great, because what we're doing is arming our listeners with just some great information that I think most realtors probably don't know about. So this is awesome stuff. Thank you.
It's huge, and I think most homeowners, they're not listening to real estate podcasts, so they're gonna have zero information on this unless they're speaking with a broker who has access to some of these programs. But really, they're not even gonna have that conversation because they're self-disqualifying themselves. So if you're a realtor, listen to this. Can't hurt to talk to your current past clients that own a property, that want to purchase another property. What are their concerns? It might be, I don't think I can afford to qualify with 2 mortgages at once. That's what another lender may have told me. But then you can bring up the fact the bridge loan doesn't even require that second mortgage payment to be included into the DTI. Or if they own a property and they've owned it for several years, they want to buy another property, you can do some math with them, see how much equity roughly they have on that property and what their means are to be able to purchase another. Because if they have equity, there's usually a way to make it work. It can't hurt to have those conversations. Any past clients, anyone who owns a property, just check in, see what their concerns are, see what their level of apprehensiveness is, and help them overcome that by educating them on these programs. I'd love to have you speak with my broker, my lender, to open up their mind with so many different programs that are out there that really the vast majority of my clients didn't know they existed until they closed on it and they became super, super grateful. So many awesome programs. The bridge loan and the HELOC are not the same exact program, but in many cases, they can both really knock off the same accomplishment of allowing you to get liquidity by using equity in a current property, allows you to put in stronger offers without having to have that contingency included, and just a quick way to get that cash and be able to purchase a second property.
Awesome. Well, I want to talk a little bit about the current Iran situation and what that's done. Not having a conversation about the political implications of that, or sort of where we fall on our support of it, but just talking about how it's impacting the lending world. So we know it's impacting gas at the pumps. We know it's impacting possible other goods and services who that need to travel around that area. And so, how is it impacting rates?
Yeah, it's funny, DJ. I think we were just on your podcast a month ago talking about how happy we were. We hit a 3.5 year low. We hit 5.99 average interest rate for maybe 2 hours before that weekend hit where the Iran conflict started. So it's what it is. We can't control rates, but it can't hurt to know what's going on so you can explain this back to your clients when they have any concerns over interest rate. The number one thing to keep in mind is the number one driver for mortgage rates is always going to be inflation, right? So inflation, when cost of goods rise, mortgage rates tend to rise with this. So right now, the big fear, the big concern in the marketplace is the fact that the Strait of Hormuz, where massive percentage of the world's oil comes and goes every single day, has been shut down. So a tiny fraction of the oil is being distributed to other countries. So the fear is this is going to cause higher inflation. And that's why we saw mortgage rates shoot up almost 3/4 of an interest rate over the past 40 days since I was last on the podcast, DJ. So not great news, but this is what's happening. We're going to talk about some ways we can overcome this and how we can empower our buyers to work through this. That's essentially what's happening right now with the economy and how that's impacting mortgage rates.
So, how, if you were a real estate agent and rates have just jumped up, and perhaps your buyers know this, maybe they didn't get their rates locked in when it was low because it was such a short window, and now they're seeing these larger rates and they're feeling that maybe rates are too expensive. What would you sort of say to that buyer at this point?
Can't hurt to educate them on where rates are now, where they were just 18 months ago, 2 years ago, when they hit almost 8%.
Yeah,
So 6.5%, everything is relative. It's not going to
still
be
pretty good. Yeah.
exactly, unless you're one of the historians living in 2020 bragging about your 2.5 interest rate, then I think we should still be pretty happy with where these rates are.
I,
What we have
I
to realize is the vast majority of buyers across the country finance their real estate investments. So this impacts everyone pretty much equally. So
yeah,
if everyone else is suffering from this, we can remind our buyers all of the competition is dealing with this too. Some people might pull back on their offers, they might offer a little bit lower. This is our opportunity to get even more aggressive, maybe ask for a little bit of a bigger seller concession. So now we're not going to have any closing costs, but you can also get the 2-1 buy down paid for by the
yeah.
seller. So just a good time to remind our buyers everyone is impacted by this. People are still going to purchase. They're going to use these methods. And then you can remind them negotiation power we have when payments are going to be a little bit higher. And your payment might not even necessarily be higher if you leverage components like that 2-1 buy down, where just as a quick reminder, I know we used to deal with these all the time 2 3 years back when rates were at the apex over the past few years. 2-1 buy down, very simple. You get today's interest rate, let's say it's a 6%, probably closer to 6.5%. For the first year, you're going to have a 4.5% interest rate. In the second year, you're going to have a 5.5% interest rate. In that third year, if you are still in that loan, then you would have the normal 6.5 interest rate, and it would stay there for the remainder of the loan. So the savings can be massive during that first year. They can be awesome during that second year. And third year, it's going to stay there and it's never going to adjust. It's not an adjustable rate mortgage where you have to look at the clock, see what the Fed's doing to guess what you're going to be paying each month. It's never going to change. Another benefit too with the 2-1 buy down is because it's a seller credit that's covering this incentive. If a buyer were to purchase with a 2-1 buy down and they sell the house or refinance, which is probably the most likely scenario, that 2-1 buy down gets refunded back and credited towards that loan payoff. If you do discount points or a permanent buy down, that would be non-refundable. So 2-1 buy down gives you a little bit of a insurance policy because you're not overcommitting. If you happen to take advantage of an opportunity to get a lower rate, that's going to be credited back to you.
Yeah. Well, I mean, look, I made the decision to sell my 3% uh condo, and now I'm at 6.5% myself. And while that was a tough psychological hurdle for me to jump, because of course we're never going to see 3% rates, or we're very unlikely to see that again, of course. However, it made sense for me because, and number one, I didn't have to move. So this is the thing that a lot of agents are just thinking, well, if someone doesn't have to move, they're not going to want to, because obviously rates are, lending is maybe twice as expensive as it was, back in the 3% days. But the reason I did it was there were a lot less buyers on the market when the rates were even in the sixes, and that was about 6 months ago now, or 5 months ago. So it made sense for me to do it. I was willing to eat a little bit more because I knew I'm going to, well, hopefully I can refinance at some point. But even 6.5%, if I could make it at 6.5%, I can make the payment. Then I know that I'm going to be okay. And so, this is an opportunity to talk to sellers who are reluctant to give that up, but they really do want to move. Maybe they want to upsize, or maybe even downsize. But it's a good time to think about it, because there's just fewer buyers out there right now. There's a lot of people that are just rate conscious and they don't want to participate. So this is an opportunity for you to possibly. I got this property most likely because of that. And there were other offers, but thankfully I got it. But there weren't as many offers as there should have been in a lower interest rate environment. So, fewer buyers out there. So that's a great conversation to have.
Exactly, exactly. Less competition just makes it that much easier. And I think it's a good idea to remind our buyers too, no one has that crystal ball. Anyone's prediction is pretty much useless. Wars are unpredictable, and the war is the deciding factor and number one component for what's going to happen with interest rates. If the war is prolonged, a lot of experts are projecting a smaller recession, which could bring down interest rates. And if the war were to end tomorrow and the Strait of Hormuz would open up, oil prices would instantly decrease, and then that would also impact mortgage rates for the best. But who knows? Anything can happen. Rates could stay the same level, they can go up. It's a great idea to remind the buyers who not don't be overly optimistic to wait a couple more months for rates to drop, because we've seen that before and it's been 3 or 4 years from 2021 before rates actually dropped like people thought they would. So no one has that crystal ball. If you're comfortable with that payment, now is a great time to purchase. You do have a little bit more negotiation power than you
Yeah.
would have a couple months ago. So if a buyer's bringing up, oh, my lender just told me my payment's $180 more on this $480,000 house, you can remind them, okay, well, guess what? There's going to be plenty of people in your position that might be pulling back offers a little bit, being less aggressive. This is our opportunity to get more aggressive. Let's negotiate that price down, ask for the repairs. Let's get a seller concession or do maybe a combination, or definitely try to focus on that 2-1 buy down if they are very payment oriented. Every
Yeah.
buyer is obviously going to be a little bit different than the next. A great time to remind the buyers of what opportunities we have to negotiate in this current market with the current predicament we have overseas right now.
And even if rates dropped 75 basis points today back to that sort of low that we saw, what would happen is buyers would flood the market again, and competition increases, prices go up. I mean, it's pretty simple economics there. There are a lot of people out there that are watching rates, and this is how they make their buying and selling decisions. So I always think, let's let's not buy high and sell low, right? Let's really think about how this could work to your advantage as an agent, and at the very least having the conversation, even if the seller doesn't end up selling, really paints you in an amazing light, because you are now going and having a conversation that other real estate agents who maybe they worked with in the past, or maybe they know personally and would use them on a future deal, all of a sudden you're bringing something to them as just an option that other agents aren't. So I appreciate that. Yeah, we don't know what's going to happen with this conflict. um, Certainly, I guess we'll all wait and see. It's really changed. All eyes were on the Fed before, and I guess now it's more about this conflict and oil. So very interesting. So I want to remind everyone that the best way that you can help Austin, now he is coming on our show every month to give you this great information. Please, let's support Austin. He's an amazing lender, and not even because he's such a great guy, he is a great guy, but he has access to almost 300 lending institutions. That's pretty amazing, right? So if you went to your local bank, or even somebody that worked directly for a lender, which, that's okay too, but they don't typically have access to hundreds and hundreds of options. Of course, they work directly for that institution or that bank, and the products they have are the products they have. They don't get to shop around. Austin gets to do that. So he is going to find the best possible option for you. He's not beholden to any one company. So this is a huge opportunity. And even if you already have a trusted lending partner, you should have a second one. You absolutely need to have a backup offer every single time. Give Austin an opportunity. We would appreciate it. He's coming on this show, giving such great information to you, and help him out. Let's help build his business as well. He's a great guy. Want you to follow him on all the different social media channels, but in particular, Instagram, austin.mortgage. We will have a link to that in the show notes. He also sends an email every single Wednesday with information you can use to go out there in the world and talk to buyers and sellers. Clarence at nexalending.com is where you go to do that. Austin, thank you. This was another great episode. I am so happy you are our lending partner on Keeping It Real, and this is amazing information. We got great feedback from the last episode. By the way, anyone who is listening, if you have questions you want answered from Austin, shoot us a message. Let us know what would help you in your real estate business. We will bring that up on a future episode. Austin, we will see you next month. Want to thank everyone on behalf of Austin and myself for sticking around to the end of the show. Reach out to Austin, get on his mailing list, get him an opportunity on your next lend, your buyer, and let's get a backup offer at the very least from Austin. And as always, thank you to our sponsors, including Austin. Thank you to our listeners, and we will see everybody on the next episode. Thanks, Austin.
Thank you so much for having me on, DJ. I'll see you next month.